safe to say nobody predicted this coming into the year. 11% return for U.S. stocks, for international stocks, and negative 5% return for U.S. stocks. The 16% spread, biggest on record for a 4-month period. So the question that we're getting now, which is kind of unbelievable, is it too late to get into international stocks?
Yeah. I mean, international stocks lagged the US for 15 years. So this would have to go on for a long, long, long time to get back to the regression of the mean that would be normal. So if, definitely not too late. But I wouldn't be surprised if this gap narrows dramatically by the end of the year if tariffs get resolved. There is no question that international is heavily discounted to the US without the tariff situation. You add the tariff situation in, this gap widens, we resolve the tariff situation, it probably narrows. But this rotation from US to international is something that everybody from BlackRock to Vanguard to Goldman has been predicting for forever, right? And this is the one thing that most investment houses believe is that this rotation is long, long overdue. The dividend yield is greater overseas. The PE ratio is lower overseas. But there are people that think there's legitimate reasons for that. Like some people say Europe's a museum and that it's overregulated, and there's the heavy cost of socialism, and Greece was a warning sign of what's to come for everywhere. So I don't think we can just look at it and blanket say this is going to be sustained or not sustained. I think both have been relatively fairly priced for a long time, and the smart investors should have eggs across both these baskets.